Welcome to our fourth episode of the Forex and Crypto Trading tutorial. On the previous episode, we talked about support and resistance. Most actions we take in trading are at support and resistance levels. You buy at support, you sell at resistance. But you don't just buy because it's a support level, neither do you just sell because it's a resistance level. There are patterns in conjugation with candlesticks that need to form at that support level before you consider buying, or that needs to form at that resistance level before you consider selling. We'll be talking about those patterns, starting with double top and double bottom.
A double top forms when the market rises to a certain height, drops to a level which becomes the neckline, and then rises again to the same height, drops and breaks that neckline to the downside. A double top has the shape of an M, as you can see here. When a double top is forming, traders are expected to wait and make their entries immediately this neckline is broken, because that is the confirmation that the market will continue to the downside. Now, to choose your target, you have to measure the distance between the first top and the neckline, because that is the same distance the market will travel from the neckline to the downside. This brings us to the reason why I once said the best result you can get from a potential double top or double bottom is 1:1 risk to reward ratio. Now, here's the explanation to that. After you make your entry at this neckline, the best thing to do is to place your stop loss at the apex of the double top. Now, having your stop loss here and your entry here, your target here, you can see that what you stand to lose if the market goes against you is the same amount you stand to lose if the market goes your direction. Now, this is why you will have a 1:1 risk to reward ratio from this trade. Now, disregard the fact that we have a wick extending further to the downside. This hardly happens. Remember, trading is all about what's most probable. You trade what is most likely to happen. A double bottom has the shape of a W. It is formed when the market drops to a certain level, rises to a height which becomes the neckline, and drops again to that same level, rising and breaking the neckline to the upside. While this pattern is forming, traders are expected to wait and make their entry once this neckline is broken. So this means your entry will be here and your stop loss should be at this low. To place your target, you have to measure the distance between this neckline and the first low. That will be the same distance the market will travel from this neckline to the upside. So this should be your target with your entry here.
There are three key things to note about double top and double bottom. Number one, double top and double bottom can form on any time frame. So this is why you must always explore all the major time frames when looking for a trade opportunity, regardless of your strategy. Number two, double top is a bearish pattern. It forms at resistance levels. Double bottom is a bullish pattern. It forms at support levels. When double top forms, it's a sign that there has been an intrusion of sellers at that level, forcing the price to the downside. When double bottom forms, it means that there has been an emergence of buyers at that level, pushing the price to the upside. Number three, the most reliable type of double top or double bottom is one where the tip or wick of the second top or second low is slightly longer than the first one. This is because most traders, impatient traders, would make their entries at the neckline without waiting for the formation of that second top, while placing their stop loss at the tip of that first top. Now, when the second top starts forming, it will extend its wick beyond the high of that first top, wiping out those traders that entered early at the neckline before the big move. The market is like a mini bus. It travels with only a few traders, and unlike a train, doesn't travel the direction of majority.